Hey everyone, I'm Sloane with Invest Vegan, and I am here to dive into one of the most interesting questions in the modern financial marketplace from a couple of different perspectives, right? I've heard really sophisticated institutional investors, wonder what the heck is going on with index funds. What is their deal? Um, I've heard lots and lots of retail investors have the same question too, and I've even heard conspiracy theorists of all shapes and sizes talk about these things in various ways. So I want to sort of set us off, with a solid understanding of what they are and how they fit into our lives, and what we can do to address their various shortcomings. But first, I need to tell you that I, Sloane Ortel, am a registered investment advisor. I, offer services to clients through Invest Vegan LLC. This is not investment advice. This is way different than what I do for clients. This is information only. And I'm putting it out there because I started this firm to serve folks who are not well served by the traditional financial industry, if that makes sense. I'm a queer trans woman, she and her, please and thank you. Um, and I find that lots and lots of folks are just kind of not sure how to deal with various thorny problems that relate to the intersection of ethics and money. And so as a result, they just kind of don't deal with them at all in various ways. So I want to make sure and make the highest quality educational material that I can come up with available as freely and widely as possible. So that's what this is about. It is not investment advice. Now, with that said, ooh, that's cool. My mouse does cool things as it goes across the screen. As you might guess, I'm a little bit new to this. Now, to go, and explore this a little bit further, I must first jump into this weird circle. Now, I am in this circle and in this setting because I think that a library is a really good metaphor for understanding what the stock market is, right? It is, I mean, if you think about the New York Stock Exchange, right, it's a big Gilded Age building. That's true of a lot of libraries. But, in a library, there are thousands and thousands of books, right? And some of them are much more popular than others. For good reason, right? Like some of them are, the elements of style, like really classic texts that get referenced all the time. Some of them are like, the kinds of books that I have here, like a history of life insurance in its early years, that like there might be one person on earth who cares about, and it's me. So what does that have to do with an index fund? I'm glad you asked. If I wanted to characterize what was going on in this library, there are a lot of ways that I could do it. One of them, and one that's sort of become very popular, is to go and say, okay, well, let's look at just the 500 most popular, as in most widely held, widely owned, and valuable companies, and let's decide that let's say 500 of them, once we add them all up, that constitutes some version of the market, right? And that makes sense because if you think about it, we need a way to characterize the market, right? Otherwise, the news anchors, when they talk about what happened today on Wall Street, would just have to be like, well, a lot of stuff happened and it was chaos, which is, the truth. But thanks to an index, they can say, well, the stock market closed up slightly on Wall Street, and index funds perform that basic function. They allow us to think about what it is that's happening on the market in some sort of way, right? Or indexes perform that function. The index fund is a huge innovation, right? It was started by a bunch of folks, including this fellow, Jack Bogle, who is one of the most influential, if not the single most influential person in the 2000s, like the last century of investing. His basic innovation is like, all right, well, you've got the index that you're using to characterize the market. What if instead of just characterizing it, you actually just bought the index, right? So your experience as an investor would be exactly the same as the one that the newscasters are reporting, right? If you saw that the S&P 500, to pick an index, was up or down by a set percentage, you would open up your portfolio and be like, "Yee, gosh, wow, my portfolio is doing the exact same thing. That's so great." Hugely simplifying for massive, categories of investors. It winds up reducing cost and improving the end result for those people. And that's why it's kind of like one of the few financial innovations that we talk about as being unquestionably positive in a lot of senses. It's sort of similar to the ATM, which might not seem like that big a deal if, like me, you grew up mostly having the access to the internet. But if you didn't and you had to interact with bank tellers, you know how much of a benefit it was to have access to something that could just, do a lot of these same repetitive transactions, without needing to talk to a human being. An index fund is that same tier of innovation. And maybe that's why they've been so popular. This is a chart of the lime green stuff on the bottom is what you might think of as the old school way of investing. It's an active mutual fund where you pay a bunch of people in bow ties to pick the stocks that are going to go up and not buy the stocks that are going to go down and build you a portfolio out of it. People have by and large been selling out of those and buying index funds with the proceeds, both as mutual funds and ETFs. And as I said, the reason that you do that is that the results are often a lot better. This chart comes from my colleagues at Fiduciary Wealth Partners, where I'm on the investment strategy roundtable, and what it shows is the blue line is a portfolio of just index funds, right? Various index funds for to produce a nice diversified portfolio. And the red is the top quartile, the best 25% of college endowments, which tend to be the most sophisticated and well researched investors on the planet. What you find is that index fund portfolio overwhelmingly outperforms even the top endowment portfolios. Now, if that's not a good reason to think about, index funds as kind of a good thing and maybe a good addition to your portfolio, I'm not sure what is. But the title of this video is What's Wrong with Index Funds, not why index funds are the greatest thing in the history of the world. So it's time to start unpacking that a little bit. And first, I need to show you a person, right? This person is David Bilzer, who for a very long time chaired the index committee at the Standard & Poor's. He's retired recently, but I use him as sort of a stand-in because he retired very recently, like in the last maybe year. And he also just sort of is iconic in this very funny way that some investment people are. Right? I joked about people in bow ties picking stocks that go up, and he's a guy in a bow tie. And I think that when we start to think about the shortcomings of the index fund, really it's when we start to expect things from it that it wasn't designed to do. And for most of the people that I talk to day to day, it's when we start expecting the index fund to somehow align with our values, right? The values that underpin the index fund are society's values as a whole, right? And if, like me, you happen to be, let's say hypothetically, you were a queer transgender vegan, it would be reasonably likely that your values were somewhat distinct from society's as a whole. Now, everybody has their three adjectives that make them a little bit different from society as a whole. And so that's why we've seen such a push recently towards, kind of constructing new methods of coming up with, with index type products or investment products that people can use for, kind of the bulk of their equity exposure, right? Like what we're saving for the long term. Another criticism of index funds, which is hilarious given what I just said, is that they stand likely to destroy capitalism, which, we should be so lucky. I mean, honestly, if index funds are destroying capitalism, or if index funds, as they were, had any chance of destroying capitalism, the revolution would have already happened. I mean, they're overwhelmingly the majority of, most flows, most everything. But why would anybody think that? If you think about it, it's kind of a zany idea. Well, because as an index fund investor, we think about companies differently because we own all of them, right? So, like an investor in, the broad S&P 500 index might be inclined to reach out to Moderna and say, hey, you should really give away the vaccine that you've developed, even though you could profit from it pretty significantly by selling it, because that would benefit the other 499 companies in my portfolio so substantially that I don't even care that it would cause you to make a loss. That is the argument for why it's socialism or why it will destroy capitalism. In practice, it doesn't really hold because the venues that index funds have to actually make those sorts of phone calls and get listened to, don't really get taken advantage of by and large. This is a chart from Morningstar, which is a data provider in this field that shows how index funds voted, various different index funds that are all designed to track the performance of the S&P 500, how they voted on a bunch of different shareholder resolutions that were aimed at advancing various social or environmental goals. And what you see is, like, up at the top, you have one fund that votes for all, or four funds that vote for all of them. Down at the bottom, you have a bunch of funds that vote against basically all of them. And oh, by the way, the ones at the bottom happen to be kind of the larger ones. And this is a big deal. It means that these funds tend to not be taking advantage of the opportunity that they have to influence the shape of corporate practice and corporate policy. And instead they're just sort of doing what they say they're going to do, which is produce an investment return that's as equivalent as possible to the index itself. Again, that's what they're designed to do. And things get kind of weird when we start expecting them to do other things. Now, what other issues do we have with index funds? Well, if you, like me, think climate change is real, you might be concerned about the problem of stranded assets. Now, what's a stranded asset? Well, think about what happens after we transition fully to, kind of green energy alternatives, right? If you're, looking at a bunch of oil storage tanks in South Korea, like this one, or like these ones, well, gosh, no more oil to store. What do we do with those storage tanks? I'm sure that there is another use for this land, another use for the metal, but it's traditionally very hard to take one thing and turn it into another thing. And it's hard to assume that the new thing that comes out of these things will be as profitable and have the same sorts of characteristics as the oil storage business that's currently there. So the thesis goes that in most transition scenarios, fossil fuel linked energy assets are subject to a substantial, effectively permanent devaluation, right? Now, how big will that devaluation be? How quickly will it happen? And how universally will it be felt? Well, those are great questions, and it super depends who you ask what the answer is. This is an infographic from The Guardian that shows, one projection of what might happen. And I think it's just important to sort of look at, the U.S. sphere, just because I happen to be American, and that's where many of the people who are, watching this will be thinking about, and go, okay, so that dotted line outside, that's the previous value. And then the circle right here, that's the new value. So all of this space is, basically money that can reasonably be expected to evaporate over some time frame. And index funds are as exposed to that as anything, because their job is to, again, go into the library and just buy the things that everyone's reading, right? And so as long as people continue to be, holding energy stocks, as long as some people continue to be holding energy stocks, so will they, right? Now, you might be asking, okay, well, that seems pretty simple to rectify. What if we simply take out all the things that are bad? Couldn't we then still come up with like some kind of index fund that would give us all of the benefits, of the previous thing, but not have exposure to these same issues. It turns out that I'm a good person to ask about that, because what I do at Invest Vegan is produce investment portfolios that have no exposure to, or as little exposure as possible to, these various bad things that are listed on this slide. So, for instance, like, we think you shouldn't invest in companies that actually harm consumers, or, that focus on meat, dairy, and eggs for, the fact that meat is murder, but also the fact that the workers in these situations tend to be some of the most oppressed, out of any sorts of place. So, for any of these different things, like, let's just take all the bad guys out. Let's take all the bad companies out and see what we get. Now, what we get is kind of weird. It basically winds up being mostly IT companies. And if you look across the spectrum of sustainable investment products, what you'll find traditionally is that they tend to just sort of produce something very similar to this. The top few positions in a lot of the large US sustainable funds are basically Facebook, Apple, Amazon, Netflix, Google, because few people, very few people tend to see those as ethically objectionable. In this case, I do. They're excluded from this, but the tech intensity of many sustainable investing practices definitely stems from the fact that if you run this kind of an elimination exercise on an index, what you get is a bunch of tech. And another way of looking at that is like this version of this. This is the same data presented a little bit differently. The black area or the gray areas show what has been eliminated, right? So consumer staples, which have a lot of like meat and other types of stuff in it. Consumer discretionary, which has a lot of Apple, or a lot of Amazon in it, and communication services, which has Facebook and Google, for instance. That's all screened out. And what you're left with is this little teeny nugget at the top, and obviously this big pillar of IT. So what you're left with is not an index at all, and you need some way of judging the various claims that these companies make, because in this era, it's terrible that this adorable animal has come to be synonymous with misrepresentation, but it bears mentioning that if we're trying to select companies that are not just more profitable, not just more popular, but subjectively better than alternatives, we're leaving ourselves open to being catfished. And I believe that you need multiple layers of, kind of tools to protect against being kind of duped into a false sense of security with the resulting thing. Because at the end of the day, the objective for many investors is to produce a portfolio that aligns with their values, right? So that we can get rid of the kind of like dull, aching fear that many of us have that there's just some crazy moral lapse that's embedded somewhere in our retirement portfolios. Anyway, so that's why the solution to index funds is not another index fund. The solution, I think personally, is an approach that's a lot more similar to what I do at Invest Vegan. I mean, of course, I think that. But if you're curious why I think that or what I'm doing in more detail, I made another video about it. It's somewhere, one of these places. It should be up here, assuming that I learned how to YouTube. Anyway, I really appreciate you taking the time to learn about this with me. I'm so excited to bring you more videos like this in the future. And if there's anything that you're wondering about, please do not hesitate to ask, and I will make you a video about it. But that's it for me for now, and I look forward to seeing you again soon.